GameStop released its earnings today, and at the open, the stock moved down 15%. If you were buying options going into this event, you should have come out with a handsome profit. But in today's video, I'm going to be breaking down for you how we took the other side of that trade and we're selling options going into GameStop's earnings, and how we actually managed to come out with a great profit. We're going to be diving deep into the quantitative data that supported our decision and gave us the signal to be short volatility going into this event. But before we get into it, if you find value in this video, make sure to subscribe, and I encourage you to check out the Predicting Alpha Terminal. It's an excellent resource for every option trader who's serious about this game. Let's get into it. So given the whole coronavirus situation, gaming has really picked up steam as a lot of people are stuck at home looking for something to do to pass the time. And as you would expect, GameStop has rallied over 200% in the last 6 months because of this situation. Beyond that, a recent partnership with Microsoft is really adding fuel to this fire. So as we approached this earnings event, there was a lot of hype around this stock, and the market was expecting a really big move for GameStop in the near future. Now, all of this hype and excitement around the stock were causing the premiums for the options to really increase in value. But along with that increase in value came an increase in expectations for the stock. So what we're going to do in this video is break down the different data points that we were looking at, which signaled to us to be short volatility going into this earnings event. And I'm actually going to break down for you how we structured our trade to really express the view that we're going to develop as we look at these data points. So what I'm going to do now is move over to my computer and show you exactly what I was looking at over the last couple days that ended with me making a really good profit on GME. Now, a key thing to note is I am recording this video after the event, so some of the numbers here have changed from what they were before the event, but I'm going to explain to you how those changes are actually what we were looking to see happen as we went into this event. Now, as you know, a lot of the retail trading community uses options as a product to get leverage on a directional bet for a company that they're interested in. So going into this earnings event, it was no surprise to see that the option premiums were extremely inflated for this stock, seeing as there's huge retail sentiment going into it. In fact, if you looked on StockTwits, you would see that the retail sentiment was over 81% with 24,000 people watching it. In fact, the January expiration options, which are these ones over here, were trading at 200 IV going into this event. It's now trading at 140 IV, which is actually what we were hoping to see happen after the event passed and that event volatility was sucked out of the options. So one of the first things that we looked at was this graph right here, which is the implied volatility versus the realized volatility historically. So let's go ahead and change this to a 3-month outlook to get a more zoomed in view on how the relationship between implied volatility and the actual volatility that we've seen with the stock have moved together in, let's say, the last 3 months. And take a look at this, right? You can see that implied volatility and realized volatility have a relationship where the spread between them tends to close. If implied volatility goes above realized, we're going to see them come back together. And if implied goes above realized, we're going to see them come together once again. Well, just before the event, let's say we're over here right now, we can see that there was a big spread between the two, almost 60 vol points, right? 162 versus 105 for the 30-day expiration options. So given this, we can expect one of two things to happen in the future. Either realized volatility will increase to meet the implied volatility, or the implied volatility will come down to meet the realized volatility. Our bet was that the level of implied volatility would come down to something closer to what the realized volatility is. And something else we can look at to really articulate this point is the relationship between the two in terms of relative value. So if I put in GME here and here and change this to realized volatility, run the program, we're now plotting those same two lines as before, but now we are looking at the ratio between the two as well. And what we can see here is that the relationship between the two is mean reverting. When it goes too high, it tends to come back down, and when it goes too low, it tends to come back up. Now, besides these little pops here and here, we can see that it was at the higher end of the range going into this earnings event, and we could expect it to be coming back down, mean reverting back to that middle ground between what the implied volatility and realized volatility should be. That's really what we wanted to structure our bet around, and our bet that we end up taking is that the implied volatility is going to be the correcting side of it, meaning it's going to come down to meet the realized volatility. Now, how did we decide that the implied volatility was what would come down? And it's not that the stock is going to rally even harder and the realized volatility is going to come up. Well, for that, let's head back over to Vol Insights and take a look at this feature here called the volatility cone. So now I'm going to just adjust what we're looking at here quickly, taking off the max and min and looking at the current, first, third quantiles and the median. And what we have here is a range that the stock usually falls within, as well as the median or the average level of implied volatility that we typically see for the stock. Now, going into this event, this right here was up here at about 200. It was significantly higher than what we're seeing right now, much higher than the third quantile, meaning that the implied volatility was above what we see for the stock 75% of the time. So it made sense to us that the level of implied volatility would decrease after the event and as we move into the future. Now, the last thing we wanted to take a look at before we went ahead and placed this trade was, what was the market implying to happen for the earnings event itself? To do that, let's head over to the Earnings Analyzer tab to see what we can find. We're going to be looking here at the moves chart, looking specifically at 2020-09-09. What we can see here is that the market was implying a 19% move for the earnings event, and what we ended up seeing was a negative 15% move. So going into the event, we were aware that the market was implying this 19% move. And we also knew that the average move for the stock was only 8%, which indicated to us further that the implied volatility level was just so high and that there was no way it would be able to maintain this for a long period of time as we move forward. So what we decided to do was structure a trade that gave us exposure to the level of implied volatility. We didn't really care which way the stock would go. We didn't really care what the exact outcome of the earnings event would be. Our view was that the implied volatility level going into this event and moving into the future was too high. It was going to come back down to a level more in line with what we expect to see for GameStop. So instead of selling a short dated option that gave us the most exposure to the event, just the event itself, we sold a further dated option, the January monthlies, which gave us more exposure to Vega. Vega is one of the Greeks that impacts an option contract. And what we were expecting is that Vega would decrease. So by selling the option that is more sensitive to Vega, we expected the premium of the option to come down, meaning we would be making money as the level of implied volatility or the Vega decreased. So we sold the January $16 strike and $22 strike straddle for $6. And after the earnings event, the market opens up and we were able to exit that position for $4, leaving us with a $2 per contract profit, trading the earnings event of a company that had an absolutely massive move and being on the short option side to top it off. This really goes to show how important it is to understand your product and be able to look beyond the charts when you're making a trading decision. That's why there's so much power in a terminal like Bloomberg or Predicting Alpha. Now, not all of our trades are going to be as big of a winner as this one, but it really goes to show you how important it is to understand your edge and understand the position you're getting yourself into when you take a trade. Because in the long run, having that type of an advantage, being able to price the option better than the market and forecast what's going to happen in the future, allows you to build a book that compounds out over time and puts you in the driver's seat of your own financial success. But like I said at the start, if you enjoyed this video, if it added some value, gave you something to think about when it comes to trading options, please leave a like, ask a question, and please subscribe. It really helps out our channel and allows us to keep making videos like this for you. We'll see you in the next one.